Welcome back to Total Money Management. The week that was, ending 24th of July, 2026. The week that was, signals and noise.
I was going to say, there's one for the books.
We're off to a shocking start.
We've been flustered. We were out there this evening. I pulled up. Steve goes, "Have you got any wine?" Like, no. Next minute, all three of us
can't operate without booze, mate.
All three of us are in the Batmobile hunting for wine.
Yeah.
This will be our third attempt at getting a podcast from the undisclosed location
with a video,
bunker.
and audio.
We can do it
together.
I believe in us.
I haven't looked.
Absolutely.
Did you upload the video last week?
No, because it's only him for 25
halfway
minutes.
through, it cuts just to Jacob's face from his laptop's webcam.
It's a what do you call it? Like a one chin or something. Yeah. It's just my chin.
Uni chin.
Righto, stop talking about yourselves.
Right,
Righto, the war's on.
What don't we like?
The war's on. It's getting worse.
Well, I saw something yesterday where Trump's back on his social media page saying, every time they shoot a ship, I'm going to blow up a bridge.
Yeah.
And I'm going to blow up an oil refinery or something like that.
There's no negotiations. Normally with this stuff, with wars, there's what they call a back channel, right? So publicly they go, hey, we're not negotiating, but behind the scenes they've got phones hooked up and stuff.
Yeah.
And they're actually negotiating. I don't think there was a rumor that there is negotiation going on, but I don't know whether that's true or not.
Well, I just don't understand what the signed treaty was for then.
That was just to delay, Jacob. That was to give. It's not unusual where you have a war and then you go, oh man, we need it'd be good if we could get 2 weeks where we could reload the bullets. And it's like, yeah, cool, okay. Yeah, we'll negotiate. Let's have a ceasefire. They have a ceasefire. Everybody stores, everybody gets ready again. And then they go, right, they didn't comply and we're back at it. Yeah. And that's what we've got going on.
Just tit for tat.
Well, it is, yeah.
Well, I think it's more important from an investing perspective to just widen your time frame a bit. Rather than looking at the daily volatility up and down and getting all stressed out. Look at it over the next 5 or 10 years. And
yeah, the thing that concerns me is that, and I think we talked about it maybe a couple of weeks ago where we talked about, remember I went, oh God, buy a freezer, we're going to be short of food and that sort of stuff. It concerns me now that is actually a valid argument now to say, okay, we better think about it because, see, I don't think we realise it's not just oil. It's like helium and fertiliser. Do you know what I mean? It's like, oh, we could have oil shortage. And it's like, yeah, we could also have a food shortage.
Yeah, what about neodymium?
And that's when things get really ugly, right? And so if they're not talking and we're back to how many ships out of the,
I can't have a look because I'm not allowed to touch my laptop today.
All right,
don't
I'll
touch
look
it.
up the ship
But
tracker.
the other thing is too, see, Iran came out today, Thursday, and said that they've mined the Oman side of the strait.
Right.
So in other words, Iran has one lane and Oman has another lane. Well, the Iranians have said we've mined that, so you can't go through there. So in other words, it's blocked off completely.
Mined as in underwater mines?
As in, mines. Yeah, bombs, right?
Wow.
So that's why I say now the Houthis, who are friends with Iran, if I can put it that way, they're threatening to cut off the Red Sea access. So in other words, if they did that, mate, the world is in a world of pain. Yeah, it's going to be really bad.
It's like it's already bottlenecked, but if you do that, there's no point even bothering.
Well, I think oil, to make this about investing, I think oil's up 20% in like 2 weeks or something.
Yeah.
And
it's been a good time to rebalance and kind of take stock.
Yeah, it's a tough one, Jacob, because it's just always this thing with rebalancing, right? Which is like, oh man, I've done all right. Should I rebalance?
Yeah.
And it's hard, but I always sort of say, well, you're
tell
better
the
off
story about this morning with gear.
Yeah. It's, rebalancing is just, you're better off having money in the bank.
Yeah.
Particularly at this stage where, the Cape's really high and the market's really on fire, right? You got huge volatility in Korea. Like there's just like red flags everywhere, right? And you just look at it and go, it can disappear. Well, oil was at 110 and blink, they do the MOU. Next minute it's back to 75.
Yeah.
Right? Now it's back at, I think, 85 or 90 or something, right?
Yeah, it's in that range. It's been a good week.
It's hard with the volatility though. We're going to talk a bit more about that.
Yeah.
But
it looks like it's coming back to the ASX as well, because it's been pretty flat for the last couple of weeks, which is sus because it was swinging a fair bit, and then there was a decent amount of intraday volatility today.
Yep. And look at Korea. Like Korea's been nuts.
Yeah.
Right? Korea's been crazy.
Well, did you see your mate Elon, Tesla's earnings are SpaceX and Tesla's earnings fell massively short,
What?
and they've
No way.
who would have
No
thought that?
way.
Yeah.
And they're down. I think Tesla's down 3 or 4% today.
Well, I think SpaceX is now down 20%
It's
from the
below
IPO, I think.
25. Yeah.
25, yeah. So,
It's below its
look,
IPO.
At some stage it rolls over, right? It can't just stay. The Cape at 42 means everything's got to perform perfectly without a hitch.
Yeah.
Well, that's not going to happen because the other side of the equation is saying, and people wouldn't rush in more, right? So in other words, they wouldn't push up the price past what they've already got. And it's like, well, that's not going to happen because everyone's going crazy, right?
It's almost like if anything's certain, these stock prices are going to go up double what they're actually worth.
Yeah, well, this is why I say it'll just get worse and worse.
Yeah.
Right? So anyway, the other thing I noted today was Trump, I think it was today or yesterday, Trump has now given Saudi Arabia the all clear for nuclear enrichment, uranium enrichment.
Right.
So you can see what's going on there, can't you? They're saying, well, if Iran's going to have the bomb, we're going to have it as well.
Yeah. I mean, it feels like another version of Oppenheimer.
Absolutely.
Like, we're going to use this for energy.
Yeah.
Next minute.
Yeah. But, in all seriousness, this is what we've been talking about with war, right? You can see the nuclear powers. Everybody's talking about going nuclear.
Yeah.
Right?
Well, it makes sense to do that. Like, on paper, if we were rational people, it makes sense.
Yeah, it does in game theory.
Yeah.
Right?
But we're not rational and we love to blow each other up.
Yeah. But it's so weird, because you think everyone agrees that nuclear is kind of like totally last resort. Mm-hmm. But no one ever agrees to use it. No. And it's like, okay, so what? We just build these bombs and go, we've got them. And it's like, okay, but you can't use them. It's like, yeah I know, but we've got them.
This is how big it is.
Well, you don't want someone else having them if you don't have them too.
Yeah,
but,
yeah.
If you all start using them.
Yeah. But that's what I mean, Tom. It's like once one gets them, it's like, okay, now we get a chain reaction.
Yeah.
Right?
Hopefully Trump doesn't.
And everybody's got them. France has got them, Israel, the US, China, Russia.
UK.
Pakistan, North Korea. I think England's got a few. So, but it's growing. And I think we said last week, just have a little bit of a look at uranium and explorers, and because I think at this part, this is the thing I was just looking at today. We talked about Northern Minerals, right, which is a rare earth company in Northern Territory. Right? I think it's a really good company. Nothing of this is advice. I hold it. I've held it for a long time, and it still owes me a lot of money. But it's got a heavy rare earth side.
Yes.
Right? So I think the shares are like 2 cents or 2.5 cents or something, right? I look at it and say, all right, I'm going to throw 5,000 at it and just leave it and forget about it.
Is that one of Gina's?
No. Gina has Arafura.
That's it.
But it's in the same sort of area. But Northern Minerals has got neodymium and terbium, which are two of the heavies that are really critical, right? put it this way. If the world doesn't utilise this mine, well, something's gone on, right?
Yeah.
Because it's got great stuff. So my argument is, and with uranium, you look at some of these sort of little ones and use that John Templeton idea, right? Which is, hey, I've got 10 grand. All right, I'll put $1,000 in 10 of them.
Yeah.
And 6 of them won't work. 4 of them will go gangbusters, and in 10 years they'll have all, quadrupled or something.
And it's all paid for itself then.
Yeah.
Yeah.
Yeah. But the important thing is just saying we're going to, you can't spend money and then go, oh my God, it's down 20%, right? Because these things are really volatile.
Yeah, what I get worried about is people putting too much into these penny stocks, and then they just go.
Agreed, Jacob. Yeah, and those stocks, I can tell you from experience, they are super volatile.
Yeah.
The second part is they need 500 million, right? And the market cap is 120. So they've got to constantly go back to the market or shareholders and go, hey, we need more money, right? And then the stock price is 5 cents and they say, we'll give it to you at 4. So the stock price automatically drops to 4.
Yeah.
Well, there's 20%.
That's what I mean. 5 to 4 is huge.
Yeah, that's what I mean. So you've got to be prepared to sort of put them in the drawer and go, okay, in 5 years, I bought it for 2 cents. It might be worth nothing. It might be worth 1 cent, or it might be worth $1.
Yeah.
Right? There's a lot of people who do that on the ASX, right?
Yeah.
Because you've got a mining, strong mining community, right?
Yeah, well, I mean, it doesn't matter. You could be on a Reddit forum and everyone's got their own
Yeah,
recommendations.
mate, 100%. 100%.
But that's where the asset allocation comes in, because
Yeah.
if you only had 20 grand in total to invest and you spread that all out,
Yeah, yeah.
you could find yourself
Yep.
down 90% in no time.
Yeah.
Well, I think I started buying Northern Minerals at 6 and now it's 2. And I've got a few others that are down 70 or 80%, but I've only had, like 5 or 10 grand in them. So it's not like I put 100 in and gone, oh man, now they're at 20 grand.
Yeah.
Right. And if you feed in over time, generally, if you pick the right sort of company that's got, as I say, Northern Minerals has got a good deposit, good potential, rare earths are rare, we're going to need them, blah, blah, blah. It's a bit like, okay, this is probably not a bad little specky.
Yep.
Yeah. I mean, you look at the length of time they've been existing for as well, because there's so many pop-up mines that have popped up in the last 6 to 12 months, all this backing from private investors and private credit and private equity, and then they just go through the floor on negative earnings.
Well, part of the problem...
Don't talk to me about
Ruby Mines?
Yeah, Ruby Mines. Yeah, that was one of them. All right, and last point was, how's Australian property going?
Yeah.
Now, correct me if I'm
It's
wrong.
done very well.
I think this week was Hendo's birthday, or was that last week?
Did you give him a ring?
Is he living rent-free in your mind?
Mate, $60 million portfolio under the age of 30.
Did you call
Hendo's killing it.
Yeah.
Unreal.
And apparently, latest Hendo ad, he doesn't care about negative gearing. So
Why would he?
why would he? He's got 60 million under the age of 30. I don't know whether that 60 million's actually net. I think that might be 60 million minus probably maybe 50, maybe 55. Right?
It's a lot.
But anyway, Hendo's a year older and a more experienced, so.
Yeah.
Sign
But
up.
I think, caveat here, I'm 63, but I think taking advice from a bloke who's got 60 million under 30 and it's come down in the last market cycle might be a little bit, I don't know,
Well, looking across what we get a few people reach out to us that are in the property market, mortgage brokers, including one that actually helped me with my mortgage not so long ago, reaching out to me going, hey, what are your thoughts? What's happening? Not sure what quite's going on. Apparently the top end of the Brisbane and Sydney market's fallen off a cliff. I don't have stats, but he's reaching out to me saying, hey,
Something's changing.
there's something bad going on here.
Yeah.
And people are scared. And what's happening is people are scared and then people are stale as well. So they're not acting. So there's this weird kind of wait for it moment.
Yeah, I think what's happening, Jacob, is investors have just investing loans, the demand has dropped off like 40 or 50%.
Yeah, it's huge.
Right, so that's dead in the water. Even the first home buyers have dropped off. Mm-hmm. And, if you're an investor, you're looking at it going, okay, well, I'm not interested in negative gearing. I want capital gain. Well, prices are falling. Okay, scratch property. The other side is the first home buyers are saying, well, okay, if prices are falling, I won't rush in.
Yeah.
Right?
Yeah.
I'll wait another 6 or 12 months. So from that point of view,
I see what you're saying.
You can see it,
There's this gap starting. And the people in the middle that are incentivized on actually building a living off of this.
Yeah, absolutely.
They're stuck and they're leveraged up themselves.
That's why I think you're going to have a lot of, real estate agents, buyers agents, because you've got to think this has been a huge industry.
Yeah.
Like buyers agents, real estate agents,
brokers,
all of this stuff, right? Yep. And so it's just come to a screaming halt. Mm. So from that point of view, and again, I'm not having a shot at Hendo, but if you're young and you've grown up under this cycle, you haven't seen a downturn, right? And I remember when I was in business, when I was working, and we had a recession, right, in Paul Keating's recession. And I remember saying to the boss, Jesus, this is like really bad. What do we do? And he said, well, you just got to fight harder for business. But it's really tough, right? Because people are generally going, dude, I'm not buying. And it's like, oh, yeah, but it's like, nah, I'm not buying. And that's what I mean. You get a point where it just falls off a cliff.
I wonder what the volume of increased listings are on like realestate.com and Domain and things like that, because if the listing volumes increase significantly, then there's people freaking out.
Yeah, I think there's two parts to that, Jacob. One, I'm not sure on that, but in America, one of the things that's happened, particularly among the boomer community, right, which is older people like me, what happened in America was apparently with COVID, and I think I said this last week, a lot of boomers were encouraged to go in and buy a property and Airbnb it. Hey, you're going to make 10 grand a month, you'll be rolling in it. Then when rates went up, Airbnb dropped off. And then when they came to sell it last year or this year, and the agent went, yeah, you bought it for $1 million and it's worth 900, they call it rage delisting. And so what happened was what is happening is the boomers are going, well, that's BS. It's worth 1 million. It's like, dude, it's worth 900. And what they're doing is the boomers are saying, oh, well, bugger it. I'm not going to list it.
Delete it, yeah.
But my argument is good. You'll be relisting it at 750.
Yeah. Yeah.
Right? Like you're just shooting yourself in the foot. Yeah. So that's why I say if you can hold through it, home prices will probably fall steadily. But if there's a like if it's costing you $500 a week and you're looking at it going, and I'm not going to make any capital gain, that's when you say,
well,
okay,
why would I hold it?
Why would I hold it, right? That's when you go, actually, I think I'm going to sell.
Yeah, I mean, you can probably make do for a couple of years if you need to, but it might be 10 without fear mongering. It might be a long time that you're holding on to it,
or at least it'll, like we've said before, stagnate, right? If rates are going to continue to rise and wages aren't going to catch up, and these new policy changes, like the incentives aren't there to drive people to pile in right now.
Yeah, 100%, Tom. Yeah. Look, I could be wrong, happy to be wrong, but personally, I think it's over. Right?
Yeah.
The property game is over. It's had 25 years in the sun. It's been great. Thanks for coming. But as I said, the government are sending people a signal, and they're saying to people, if you think you can just go and borrow money, sit on your bum, charge a fortune in rent and make a big capital gain for zero effort, sorry, that's not what we want in this country. We now want to go back to building stuff.
But if these changes don't kind of turn that around, what are other measures that you could see government taking?
In terms of what? Making property...
making property less of a thing that people just want to throw all their money at.
Right. You mean de-incentives?
Yes.
Well, I think they've already made the start. Well, there are other ways to do it, Tom, which is just say, okay, we're not going to give stamp duty concessions, right? So in other words, all of those incentives that push people into it, when you start rolling them back, that's when it changes, right? Because it's the same in anything. If you subsidise something, people will use it. Like electric vehicles, right? If you subsidise them, well, they'll buy Chinese EVs every day of the week, right? Because the Chinese government are subsidising them. But if you said to them, no, actually, look, there's no more subsidies. The BYD Ute's gone from 30 grand to 82. It's like, Jesus. It's like, well, that's how much they've subsidised it.
Yeah.
So when you look at property and you say to people, well, look, we're not going to give you negative gearing changes, right? We're not going to allow you to have capital gains, all this sort of stuff. People go, well, hang on, the equation's changed.
Yeah.
Yeah.
So if
and sustained higher interest rates, I think if you keep an eye on interest rates being 6.5, 7, whatever they're going to be, people can't loan. They can't loan to what the property prices are valued at.
That's why I say at some point, Jacob, it becomes purely numbers driven.
Yeah.
And again, and it's the same with stocks, right? You get to it, the old Ben Graham stuff of in the short term it's a voting machine and in the long term it's a weighing machine. And what he's saying there is in the short term, it's a voting machine. We all think property's great. We all pile in, right? Then when it rolls over, then, and we'll talk about this as the emotional stuff. Then when it rolls over, you go, maybe it'll be all right. And then it gets to a point where you go, okay, we've really got to make a decision. Well, when you do that, you make a decision not based on emotion, right? Like you don't sit down and go, hey, come on, it'll be cool, it'll be all right. You actually look at the harsh numbers, right? And you look at it and go, darling, this is costing us $400 a week and it's falling at a $200 a week in the capital value.
It doesn't make sense.
Can we hold out for 5 years, or maybe it's not worth it, or if you say, well, we bought it for 6, it's worth, it's worth 1.1, but it's falling in price. Well, you might say, hey, let's just sell it for $1 million. We bank 400, right? That's better than sitting there watching it, just slowly eat it away.
Yeah. Well, I mean, moving on to something else that you've talked about, I think 6 or maybe longer, 6 months ago, in private credit. Even regulators now are coming out saying this is a really new thing to the market. Everyone's piling into private credit.
Yeah.
I mean, it's grown. So I've got a stat here. Local private credit lending has grown roughly 7-fold in a decade. Now around 250 billion versus 35 billion a decade ago.
Mate, that's a lot, right? That's a lot.
Insane. So the fact that that's happened, and now even regulators are going, oh, maybe just stop.
Absolutely.
And have a think about it. Because if there's cracks in that, then, I mean, you mentioned that the banks are going to private credit now too.
The money's got to come from somewhere.
Yeah.
Right? The thing that, now, let me give you an example, right? This is how, remember I said to you, they're all talking about, private credit will deliver 7.5% yield, right? And we'll pay you monthly. Lots of people who don't know what they're doing go, hey, this is great, right? Now, let me give you an example. I was talking to someone today about their superannuation, right? Young person, right?
Yep.
A little bit older than you guys, not much. Anyway, I said, what are you in? And she said, it's in high growth. Yep. Okay? No problem. I said, look, you might want to think about moving it to a more conservative position because the market's really high, blah, blah, blah. Anyway, my point being, I said, let's have a look at the conservative portfolio. The conservative portfolio...
I'm guessing not that conservative.
I think you're onto something here, Tom. was Australian shares were 7%, foreign shares were 8%, and alternative investments were 30%. Now that's, unlisted.
Yeah.
That's private credit.
Private credit,
Yeah.
wow.
Right?
And then the rest cash?
But, sorry.
Was the rest bonds or cash?
8% cash.
Yeah.
And I think the remainder was about 40% in bonds, right? But my point being, they are treating private credit, which is highly illiquid, right? They gate you when you go, hey, I want my money back. And they go, cool, Tom, give us a call. You got to give us 3 months notice. And then when everybody does it at the same time, seeking a redemption, they go, actually, no, when locking it out, you can't get your money back. So it's completely illiquid. And I think, Jacob, you pointed out in the article, it's all like 60% of it's based on real estate.
Well, who regulates
this is the bloody problem, Jacob. These things pop up, they get so far out of hand that by the time you regulate them, the horse is bolted.
Yeah, so I've got here, half of Australian private lending is concentrated in property development and construction.
I mean, Jesus, like
half of it's concentrated
in
property.
And now Albo's just cut the legs off.
New builds of
property and construction.
Yeah.
That's crazy.
Right? So that's why I say you look at it. This is why it's so important for people to look at their super, because it's a sort of tangent, but ethical funds do the same thing, right? You invest in an ethical, sustainable fund and you find out they've invested in British American tobacco, i.e. cigarettes, and oil companies, right? And it's a bit like, that's not the sustainability I was kind of aiming for.
No, we're talking about the returns.
Yeah. Well, and of course, oil divs are great. Yeah. British American tobacco's dividends are great, right? So you look at it and go, hey, we can pump this fund. We can charge 2%. We can get, 6 or 7 on the divvies and, buy a bloody windmill or something, right? And then stack it full of other stuff.
Yeah, I mean, I think trying to reduce the amount of volatility at the minute in the market is probably an idea for people. Because, you've got private credit, which is up and down. We've got oil. We've got all these penny stocks and tech stocks, which are super volatile. And moving us on into what we do like, which is the reduction of volatility over the next, managing volatility over the next chapter. But in my mind, this is just personally, I actually wouldn't mind smoothing the volatility as much as possible over the next 5 to 10 years rather than using it.
Well, that's why we talk about hedging, right?
Yeah.
You lower your volatility through hedging.
Yeah.
And that's why I'm saying to people it's really super important, because what it does is it smooths the volatility. And as we can sort of talk about now, it helps your emotional responses, right? It's really, really important, because when you get big volatility up or down, you tend to be like either really excited or really fearful.
Yeah.
Right? And it's really hard to snap out of that. So if you're hedged or, you've got some uncorrelated assets, at least you can look at it and go, okay, it's not as, quote, bad as I'm not down 10 grand. Actually, I'm only down 6.
Yeah.
Because the hedge has kicked in. That's the important stuff.
Mm. But people don't get that because they still feel like they're losing money, and especially if you've only ever made money year on year and you freak out after 15 years of the first down year or something or the first 2 or 3 down months in a row, you start to question whether you've got it right or not.
Yeah. This is part of the problem. I wrote about this in the Signal and Noise newsletter, although I think I did. The problem with property is, you think about it now, right? Let's say you bought 600 grand's worth of stock and now it's worth 1.2, right? And you get old fogies like me who go, oh, the market's really expensive. You should be more conservative. You could say, okay, well, look, Steve might be right. I'll tell you what, I'll sell 300,000, right? And take the profit. You've still got a portfolio.
Yes.
Right? Now, the problem with property is, at that point, you're going, oh man, we've made a lot of money, but you can't sell part of the property.
No, you can't sell the 5th bedroom or
right?
the
You've
porch.
got to. So it's a bigger decision, because then you've got to say, okay, well, I've made some money, but now what do I do with it? Right? And if for example, someone said, oh, well, Steve's wrong. Well, you've got 300 that you can put back into the market, right? So if you said, oh, the property's worth $1 million, let's sell it, and then, for some bizarre reason, property starts rising again, you can't go, oh, okay, let's just jump in and buy that property again. It's like, nah, it's too late. So you've got a whole new set of like costs and searches and, you know. In
a bit of a bastardized way, though, with Australian property, people have done that, but only one way. So they've used the 300 in equity to buy another one.
Yeah, absolutely.
Rather than taking it off the top, they've gone, I'm doubling down.
Yeah, absolutely.
Down. And that's irrational exuberance to a T, and the wealth effect kicks in.
Yes.
And that equals a cycle top eventually.
Well, this is why they're concerned about the wealth effect, because once property starts dropping, well, you don't borrow against it. Well, if you don't borrow against it to buy the Merc or to go to Europe and stuff, well, okay, now we're getting lower economic growth.
Yeah, right.
Right? And
I'd never considered that.
Yeah, that's a real big problem, right?
I was more focused on the people that have, you know, pulled all the equity out of a property they bought for nothing. It's now worth a lot of money to get number 2 or 3.
That's what I mean. See, when your property's rising $100,000 a year, it feels like nothing to pull 50, right, and buy a Mercedes. It just goes onto the loan and it's cool. The property's killing it. But when the property starts falling, the Mercedes is now really, really expensive, because instead of having $50,000 less on the loan, you've now got, you know, $50,000 more plus interest.
Yeah, you're paying that 50 off over 15 years.
Absolutely.
It's like
so it ends up being 110, right, on a depreciating asset like a car.
It's insane. It doesn't make any sense.
But I mean, this is like talking about what we like, right? Which is people get get caught in that momentum.
Yeah.
Right. And this is why I say, if you haven't been through 1 or 2 cycles, it's really hard, right? And I think I said to you guys before, I did it. I did really, really well, and then, you know, lost heaps of money. It was like, why? Because I hadn't been through the cycle. Whereas these days, as I say, it's a bit like I've done really well. Okay, I'm selling and taking the money.
I learned my lesson last time.
Absolutely.
But I think that's why, like, we've spoken about this a lot. Probably sound like broken records if you've been following for a while. But that's why having a system's important, right? Because when the market's volatile, you do have to act quickly.
Yeah.
But you don't want to be acting quickly out of emotion.
Yep.
The system will tell you what to do if
X, Y, you've got a plan. And Yeah, well, I see Buffett's continuing to sell, right? And he knows, right? He knows how it works.
Yeah.
You know, things have gone crazy. And as he said, I think last week, you know, it's really hard because everybody's gambling to find value.
Yeah, I'm just trying to think of a way to to help people, because most of our listeners are 35 to 45. They've been through a cycle and a half-ish. Where like Tom and I were in 2008 were kids. So how I look at it is like system 1 and system 2 of kind of reactions and illogical and illogical thinking.
System 1 is the intuitive, fast thinking, emotional one. System 2 is it kicks in after 2 days where you go, okay, now I know what I should do. I've thought about it.
But for people that don't have experience, because you can't have experience without experiencing something. But you can take a breath and acknowledge and know when something's happening. So you can get the taste for it without actually having to live through it. Where you're like, okay, I listen to some people that I trust, whether it's us or someone else. You can go, this rhymes with that. So if system 2 is telling me to just chill out a little bit, or that's like, otherwise you can't be helped.
Yeah, but Jacob, you've got to know about system 1 and 2.
Yeah.
So this is why I think I wrote it in the notes here. You know, the first thing let's chat about how we respond to volatility. The first thing to do is calm down. In order to do that, we first must realise we're reacting emotionally, not logically.
Yeah.
And see, system 1 makes you feel like you're doing the right thing, i.e., you're acting rationally, right? But the point I'm trying to make there is you have to have a framework to put that into, right? So like Tom just said before, if you haven't got a system, you don't really know that you don't even have a system, right? Yeah, it's only when someone says, hey, dude, have you thought about having a system? You go, oh, right, okay. That would make me respond differently.
Yeah.
And so
you tell me when you take profit, when you get in,
Why
are you doing either of those things?
Absolutely.
How much do you take off?
That's why when we teach decision making, right, in the course, it's really important because what you're doing is that's the first thing you've got to do is be introspective and go, hey, okay, I need to just chill here and I need to let system 2, come in over the next couple of days. But if you don't know that, you're just going to respond emotionally, right? Because you're not even aware that there's this thing like system 1 and system 2, right? And it's really, really important because you've got to be, I think I've said before, the way to do it is to sort of stand in front of the mirror and sort of talk to yourself, right? Because that way you're dealing with it and talking yourself down a bit, right? Instead, when you panic, no one's that introspective. Right?
Yeah, no
when you panic, you just do what you got to do, right? Sell stocks, right? And it's only afterwards where you sort of breathe a bit and go, oh, I feel better now. Then you start thinking through it. Was that actually the right thing maybe I should have bought some more, like, did I do the right thing, right? Do you know what I mean? You've got to have that. You've got to actually know that you're freaking out to know that you're freaking out.
Yeah, I'm just trying to think about it. Like, how do you, without experience, what steps can you take to not have to go through the bad experience?
Well, you have to, here's a plug, you have to get the knowledge, right? And that's why I say, if we teach people that, they can at least walk away and go, okay, I've got a framework to think about it.
Yes.
Now, it doesn't mean that you just sail through the next market cycle.
No.
But what it means is you at least get to check yourself. Oh, okay, yeah, the boys said this had happened. Oh, yeah, I'm feeling really panicky. Okay, I'm not going to sell. I'll just I've got plenty of cash. Okay, cool. Yep, that's good. Okay, I'm doing a long time frame. Yep, okay, that's good. I've got ETFs, not individual stocks. Yep, okay, good. You walk through it and start going, and in fact, things are really cheap. I might buy some more.
Yeah, well, you don't know what you don't know.
Exactly.
Yeah. So at the very least, if you have a framework, you know what questions you need to be asking yourself before you do anything, right?
Yeah. That's the really, it is so critical to understand that emotional stuff because, and the reason why we're talking about it a lot is because there's going to be a lot of volatility, which means there's going to be a lot of emotional responses.
We'll be broken clocks for a while.
Yeah. But I think we were talking about it last week or a couple of weeks ago about, you can see those property people who got on Facebook and just let rip.
Yeah.
Right at the government, like they really let it out. And it was like, guys, I don't think this is a good strategy.
Is that part of the system?
Right? This is not helping people to decide about their property.
No.
In fact, you are really freaking people out.
Well, that's
right?
what I mean. Like, people within the industry, whether it's stocks, finance, banking, private credit, private equity, at the end of the day, we should all be here. And maybe I'm too philosophical. We should all be here to help people that aren't quite as
Absolutely.
good get better.
Yeah, absolutely.
And 90% of people just aren't like that. They're bagging each other. No, we can't say real. We can't sit in our glass house and throw stones. But like, we should be here to help the general public get more educated and better.
Yeah.
And instead, something happens that's adverse. It will impact someone personally in the industry and just smash it. Creates all this fear.
This is the only. But this is why, Jacob, the patterns repeat collectively, right? Who comes into the market? Young people, right? They haven't been through a cycle. So what do? They buy all the Bitcoin they can get a hold of, right? They buy all the junior mining stocks they can get a hold of. They buy all the NVIDIA calls they can get, right? Leveraged ETFs, the whole kit and caboodle, right? It's not old guys like me who go, hey, this is a great idea, right? Because I've been through it.
Yeah.
So the only ones who haven't been through it are guys that are young. Then you get your fingers burnt. Then you become the old one for the next generation who come through and go, Dad, you don't know what you're talking about. Bitcoin's great, right? So that's why I say it just repeats.
Yeah.
Right? And you could have, the argument is, oh, well, we just need to teach kids about money. But, there's like we talk about with the 9 types, right? There's 9 types of people. 6 of those types are not really interested in money, right? To them, it'd be like, hey, you should learn French. It's like, yeah, really? Oh, okay, I'm not interested in French, right? So there's only a little small cohort that are actually actively interested in learning about money, right? And some of them won't even learn the right lessons.
Yeah.
Right?
Yeah.
They'll learn the stuff that the mainstream teaches, which is actually not that good.
Yeah, it's incentivized for the mainstream.
Right?
Yeah.
Just buy ETFs.
Sorry?
Just buy ETFs.
Yeah, yeah. Well,
Dollar cost average over
you'll
the
beat
forever.
95%. You'll beat 95% of them.
Yeah. No,
Right?
I could go on about where do you bring interventions in for family wealth and kids and stuff, which we won't do. But I do think there's an element of there's a middle ground of learn about how to actually manage your money and tax and
I
just
think
be
so.
sensible, because there's people. Most state schools have kind of lower socioeconomic kids and families that have no idea, and it's just systemic. Then
Yeah. But again, Jacob, too, when you look at it systemically, if we said, let's ignore the individual, if you look at systemically, our society is set up to run on debt.
Yes,
And what that means is someone's got to borrow, right? And that means someone's got to go into debt, which means somebody's going to have to borrow more than they earn.
Yeah.
Right? And that's a lot of the problem.
Yeah. Easy, just buy a property.
Yeah, well, Tom, that's what they've been doing.
Well, the
See?
intelligent people are historically buy businesses that's productive, and the unintelligent people, and I use inverted commas, buy unproductive debt, cars, TVs.
Yeah.
And that just widens the gap of inequality.
Yeah. But even, Jacob, with businesses, right? Huge numbers of businesses fail.
Yeah.
Right. And it's, there's lots of little shop owners and stuff who I see, even at my local shopping centre, where, there's probably a 20% churn rate. And I often look at it and go, geez, I wonder what those people, like they put in 200,000 to redo a shop and shop fit and stuff.
And it's closed 12 months later.
12 months later, they're done and dusted. And I often think, geez, I wonder what they do then,
It's bankrupt. Write it off.
I know, but you still, you know what I mean? Like you still got to get a job, and
it's devastating.
It's really hard.
Yeah.
It's really hard.
Speaking of really hard, beating the market over 50 or 60 years is probably hard. Now, I'm looking at a little table you've written here where there's good times to invest and bad times to invest, and it literally just proves volatility over a long time frame and mean reversion. And at the minute, obviously, we're in the US, a CAPE of 41, 42, whatever it is, makes a difference. Now's probably a bad time to invest in that market.
Yeah.
If you just look at this little graph.
Yeah.
Right.
We'll put that in the newsletter.
Yeah.
It's a regression to trend chart.
Oh,
And,
yeah.
Yeah.
Well-
So the last fall is 103% above the trend.
Yeah, which means 50-odd% to get back to trend.
And we're 207 above.
Yep. And notice that it actually always goes below the trend line. So in other words, it's 50% back to the trend line, and then it'll probably, potentially drop another 10 or 20. Now, as I said before, it will probably take a decade. It won't happen in a year, but you're still going to go a decade later and go, man.
Yeah. And hopefully it doesn't happen, but based on
This would be the first time
data,
if it doesn't, Tom.
the last 100 or so years,
Yeah.
probably a 70% crash.
Yep.
I would disagree with you, Tommy. I hope it does happen, because then
Oh, yeah. It'd be good for
it's going to
those
teach
who
a lot
know, but not for those who don't.
it's going to be catastrophic, but it needs to happen, because if it gets wilder and wilder and wilder, more crazy shit will happen, and the worse it will be.
Oh, yeah, the outcome will be just 80%.
Yeah.
It's funny because I was reading an article this afternoon about property, and one guy, I think he was an economist, I'm not sure, said, it'd be great if house prices went nowhere for a decade and fell in real terms. That would be better for affordability, Right, and I thought, I don't know whether the landlords would be too keen on that idea, buddy.
Which is
You're like, hey,
million?
your house is not worth anything more than you bought it for. And you've paid another 50 grand in interest and, and you still can't sell it a decade later. Do you know what I mean? Like, the thing about markets is there's winners and there's losers, right? And you just got to make sure you're not on the losing side.
I think that's a good place to stop.
I think so.
There we go.
All right, thank you.
Thanks for listening. And if you want to see the chart, check out the Signal and Noise newsletter.
Cheers, folks.
Cheers.